Hello, everybody, and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities space. And this is the 2023 Sunset Series, where we're taking a look back on the year and, more importantly, a look forward to 2024 to find out what the catalyst trends and perhaps surprises are in the commodities space that will shape the markets. And today we're focusing on energy and gold. And there's nobody better to do that with than Steve St. Angelo, the founder of the SRS Rocco Report, which covers how energy will impact precious metals, mining, and the economy. Steve, welcome back to the show.
Jesse, it's great to be back here. We just had a historic new run in gold, and so we've a lot of things happening in the energy market. So it's great to be back here to talk with you.
Yeah, great to have you back. And let's start with a look back on the year so far. What surprised you and what went as you expected, specifically when it comes to the energy space?
I did several interviews and Twitter Spaces earlier in the year, and one of the forecasts I had was we would see weak natural gas prices, and we have. However, I did say I think oil prices would remain strong, and I turned out to be wrong. And I've been following several energy analysts, like Eric Newdall is one of them. And when you look at the global oil inventories, they're still trending lower. Matter of fact, the global oil inventories after the U.S. has sold over 300 million barrels of its SPR, the oil inventories in the world are down at the lowest in 5 years. So typically, when you're seeing continued drawdowns in oil inventories, that isn't really a bearish action for the oil, but it has. And so one of the things is Bloomberg came out with this interesting article a few days ago that the CTAs and the algorithms have been really taking a large percentage of the trading, and so it's making it more volatile. So this could be part of the reason. But one more thing, looking at the crude oil, the commercial net short positions for crude oil are now getting back down to the lows we saw in 2016. And in 2016, the price of oil was 30, and right now we're at 75. So I think that's another indication we could go lower. And if we get a weak economy next year, we could see lower oil prices. But I think we're going to be surprised how much demand there is around the rest of the world.
Yeah, I definitely agree with that, especially emerging markets, a lot of demand coming from that part of the world. So I'm wondering how the events that transpired in the energy markets in 2023 are going to affect and shape the trajectory of energy in 2024. You mentioned you think we'll see robust demand for oil. There any other kind of lessons or insights you can draw upon from this year so far that you think are going to influence the markets in 2024?
Well, if we do go into a recession, that could have more weaker demand, and that's especially going to be bad for natural gas. Now, the issue is I called it Europe hit the natural gas energy cliff in 2021 before the Russian-Ukraine war. That just made it worse. So what they did is they cut down demand on natural gas, consumption of it, and they started to import a lot more expensive natural gas, LNG, from the United States and elsewhere. So what we continue to see, unfortunately for Europe, like Germany, is continuing to deindustrialize. And that's due to higher energy costs. So even though they have had higher natural gas inventories, uh, they had a very cold snap this winter. And so I think going into 2024, the world is just consuming a lot of energy. And even though we can see weaker demand, Saudi Arabia can cut more. And so, again, I think we'll be surprised next year with, I don't think we're going to see much lower oil prices. And if we do, that's going to really hurt the shale oil industry.
Well, I would like to pull on a thread there when you discussed European natural gas, because in a recent energy market update on the SRS Rocco report, you noted that Europe nat gas inventories take a big hit while US continues to increase. Could this be a bad omen for Europe's nat gas supply and demand situation this winter? So last winter, Europe had a seasonally warm winter, and they were able to build inventories, as you mentioned, through more expensive LNG. Um, so they were able to stave off a full-blown energy crisis. Are things different this time around? Is there cause for concern that we could actually see an energy crisis in Europe?
We may not see another energy crisis in 2024. However, Europe and Germany, they continue to plan, Germany continues to plan to add 80% renewables by 2030, and they're going to hit 50%. They want to hit 50% this year. And that's very problematic, and I can talk about that. I think the issue is as the reason why they had a big hit was they had a polar vortex. It hit Europe, and they've been using a lot of natural gas. Matter of fact, Jesse, in the last 4 days, they drew 25 plus billion more cubic feet in the last 4 days than they did the same period last year. The issue is they almost were 100% full, which they've never been 100% full. Uh, so they've been drawing down actually quicker than they have done in the last 5 years. That may slow up if it gets warmer and they don't experience too cool of a winter. If they experience a typical winter, I think you could see them survive. The problem is as they ramp up more green energy, wind and solar, they'll use less coal and natural gas, but when the wind goes offline and solar goes offline, then you have to add a lot more natural gas because you're increasing the percentage of renewables on the grid, so it becomes extremely volatile. And this is where I see the crisis getting worse, especially if we start seeing declines in shale gas production in the United States in the next several years. So yeah, the crisis may not happen next year, but I think we just hit the first stage. It's going to continue in the years ahead.
Well, speaking of renewable energy, there seems to be a growing trend of failure in the wind energy sector. You wrote that the world's third largest wind company had a 98% loss in profits. We saw Siemens Energy also take a massive hit. Um, Expand on that for us. Why is this happening? And what is the picture at present for wind energy globally?
To produce these wind turbines, especially the way they've been increasing the size, they're getting up to 15 megawatts, some of these massive wind turbines. They've been doing it so fast, and it's very expensive to do that. And so what happened is the energy prices went up to fossil fuels because you can't make wind and solar without fossil fuels. And so uh, Vestas, which is in Europe, Siemens Gamesa, which is also in Europe, and then the other one in the Western region is in GE. All of them have been losing money producing wind turbines. And so what's interesting, Siemens Gamesa just announced that they're going to start removing themselves from certain segments of the wind industry in different parts of the world. Now, China, which is now Goldwind, is the largest wind turbine producer as of the third quarter. And again, they said 98% decline in profits. You see, that's bad news because China is really the cheapest producer of these components, solar and wind, because they use a lot of coal. 50% of their electricity production comes from coal. So they have a much lower cost of production. And if China can't produce wind turbines at a profit, then you know we're in serious trouble. So, and this is going to extend, I believe, to the EV market. We just had the bankruptcy of the U.S. largest EV bus EV company, and Edmonton in Canada, 60% of their EV buses, they can't be serviced because they can't get the parts. So I think the whole issue moving to green energy, I saw we would get into trouble in 2025. We're already getting into trouble with wind. And they did 5 billion write-off in US offshore wind power plants that they were going to install. And so, and lastly, GE actually congratulated this because this would be less losses that they would have on each turbine if they went forward with these offshore wind power plants in the United States. So I think green energy is just going to get into more trouble as time goes by, especially wind.
Yeah, it's funny because the politicians pushing these green energy policies have access to all of this data. And we're seeing Germany, as you mentioned, you said it was 80% of their grid they wanted to put on renewable energy, which seems completely insane. In Canada, we're seeing all sorts of policies being implemented to a similar effect. A lot of places in the US, the list goes on across the EU. These countries whose ruling class has decided, the people will pay higher electricity prices in the name of saving the planet. So are these people in charge? They know all these things you're saying, or at least you'd think they do. Are they incompetent? Are they looking out for their own financial interest? Is that what this is? Or is there actually a sinister plan to purposefully push people into poverty and destroy their quality of life? There's also that narrative going on, to then consolidate and get more control. What are your thoughts there?
Jesse, that's a loaded question, and it may be a little bit of everything because we have to remember the elite. They're not all on the same wavelength. They're not all in the same ballpark. They all think differently. They compete with each other. And you talk to some of these people, some of these managers, some of these company owners that want to install more wind turbines because they actually believe they're saving the climate, and I think people believe it. However, let we can get into that debate whether they're doing it on purpose, whether they're doing it to make the hardships, harder on the regular public. But this is what's interesting. Germany, the Germany economic minister just announced that he's going to share the cost of green energy to all states in Germany. So if you live in the southern part of Germany, where they do that's where a lot of the industrial base is, and they use a lot of lignite coal to run a lot of their power down there, it's cheaper. Well, guess what? If you live down there, you're going to have to start footing the bill for. They're going to share green energy costs throughout the whole country. So I see this probably happening. They're going to start doing this more. The issue is, I think the energy problems with oil are going to start really hitting the head about 2025. That's my figure. It could move. There could be a bit of a fluctuation due to, if we have a recession, less demand for oil. But I think after 2025, I think moving to more green energy, it's going to be very problematic. And I think we're going to start seeing more companies, and we're seeing it. Uh, uh, Australia, Vitale is just announced that they're going to reopen another coal mine. And so they're burning more coal in Germany. So I think in the next several years, you're going to see more countries move away from pushing too much green energy. I think that's going to happen. It's going to be slow at first, but I think there's going to be so many problems with green energy. You're going to see governments start moving back, or at least their plans to expand it are going to be pulled back.
With gold reaching new all-time highs and showing great resilience in the face of positive real interest rates, the stage is set for a bull run of epic proportions. The gold mining sector has been vastly underperforming the metal itself, but that may be about to change. It's been a rough decade for gold miners, but today, the management teams of the leading companies have improved dramatically, and the fundamentals for the sector look stronger than ever. Our friends at Wealth Research Group have just released an exclusive report, Gold Stocks for Breakfast, Lunch, and Dinner, and the title should tell you just how bullish they are on the gold mining space. Download the report for free, no strings attached. The link is in the description below. Yeah, I think in the end, physics wins over political ideology. It's one thing to say we're going 100% renewable energy, which is a lot of these people's goals. It doesn't really make sense. It's just not possible in the end, unless you want to, crush the entire population and put them into abject poverty in the end. So one of the main bullish catalysts for oil that I hear about a lot is that the Permian Basin in the U.S. is experiencing a productivity decline. I know you're in this camp as well. How severe is this decline, and when could markets really start feeling the impact of that declining production?
Sure. And before I get into that, I want people to realize, and maybe your listeners do, your followers do, that wind and solar are not renewable. The wind is, and the sun is, but a wind turbine and a solar panel is just like a dishwasher or a washing machine. You've got to replace that thing in 15 years or 20 years. It's not renewable. You got to replace it. And so that people don't get that. They think once these wind turbines are up there, they're forever. Now, one of the issues is Wall Street Journal just came out with an article saying there's a 59% increase in the productivity in the Permian. What they're looking at is production per well. And that is true. Because the thing is, it's changed. So I look at the data and I go by Navi, which used to be Shale Profile. And since 2016, the average lateral of the well in the Permian was about 6,800 feet. Now, this year, it's over 10,000. And they're doing a lot of 3 mile laterals. I've seen I've seen 40,000 feet laterals. I'm sorry, I've seen almost 4 mile laterals. So they're doing a lot more of these 3 mile laterals. But when you look at the production per 1,000 feet of lateral, it peaked in 2021. They doubled the amount of fracking sand from 2016 to 2023. It was 11 million pounds of fracking sand per well, 2016. Now it's over 22 million pounds. They're pumping a lot more water. The issue is when you look at the cumulative production in the first 3 months, it peaked in 2021. So it's been declining. And so even though the wells are longer, we're getting more production, but the efficiency per 1,000 feet of lateral is declining, and that's a bad sign. And lastly, it's worse in the Eagle Ford. It's much worse in the Eagle Ford. But I think we're going to continue to see production stay elevated in the Permian, but I think we're going to see a peak between 2024 and 2025. And so, again, you can add longer laterals, Jesse, but the issue is they actually decline even quicker. I've seen 3 mile laterals decline 60 to 70% in just 7 months. And so this is the issue. They're doing longer laterals, get more oil quicker, but the declines and the decline rate is still extremely high. And so we're losing 45% of U.S. shale oil production every year that we have to replace. That's obnoxious amount of oil that has to be replaced.
We started off the show and you discussed how gold had recently reached all-time highs. Of course, I want to get your thoughts there. Firstly, why do you think gold has risen to these levels, and how do you see gold performing as we move ahead into 2024?
Well, gold has been pretty much tracking the ETF flows until until the third quarter, fourth quarter of 2022 when central banks started buying gold. And that changed it. They put more of a bid. The issue is since then, we haven't had we've had net outflows of ETFs, continuing to see net outflows of gold from ETFs, and retail bullion investors are not buying gold or silver. A little bit, but we're not seeing much buying. So we're not getting much demand there. Where the price action to me has been taking place has been in the futures market and the inverse dollar trade. That's why the gold price has been taking off due to geopolitical, futures trading, and also the inverse dollar trade. And so I think that's what pushed it above the 2100 level to 2130, overnight and very narrow trading. And so I think the issue is until we get buying from the gold ETFs, net inflows, and strong bullion demand, as well as strong central bank demand, I don't think we'll see sustained higher gold prices, even though we could see higher prices due to futures and the inverse dollar trade. So that's the reason why the gold price has been moving around uh, recently.
And you often discuss the connection between energy and precious metals. Could you walk us through how they're connected and how you see that connection affecting both markets as we move into the new year?
Yeah, I look at the markets, the precious metals markets, two ways. I look at it as business as usual, as investors are dealing in a business as usual environment. You've got central banks printing money and adding treasuries and bonds. You've got futures trading. And so I look at it that way. So I kind of analyze it that way. And I also analyze it how energy impacts everything, especially the mining of gold and the value of gold. And so what I see is right now, I did the analysis, the break even for the top gold miners as of the third quarter was about 1650, 1675. Now, this is higher than the all in sustaining cost. In my analysis, that's not the total cost. I call that's the going out of business sale. And so, really, if you want to replace gold, it's going to be 1650. And so, with gold now at 2000, at 2050, it was the gold miners are doing pretty well. And so, I think there's a lot of buffer in the gold price. So, if we get a weakness in the economy, you could see a sell off in the gold price. But the issue is, and we'll get to this maybe in a minute, the is there's the gold, precious metals, gold and silver are competing with the financial industry. And there's over 500 trillion in financial assets. And so the issue is people are getting into treasuries, they're getting into bonds, they're getting into money market accounts because they're earning a yield, mutual fund accounts because they're earning a yield. Metals, gold does not provide you a yield. And so that only works with rising oil production. And so we enter a whole different paradigm when we hit this energy cliff I talk about. And so that's the next stage why it's important to own gold. And that's when we'll see much higher prices of the precious metals.
Well, talk to us about that, how gold and silver are competing with the financial industry. Do you see perhaps a shift in the mentality of institutional investors, maybe moving forward, maybe in 2024, maybe beyond, where they start looking to gold and maybe silver? That's a bit more of a probably not a huge possibility, but that they start accumulating gold perhaps as a safe haven asset in the place of treasuries. And maybe you could also give us your thoughts on how you see the setup for silver here.
When Bear Stearns and Lehman Brothers went belly up, the market and the public realized it when it happened, right? All of a sudden, Bear Stearns lost 90% of its value in a few days, and Lehman Brothers the same way. And so people think, well, it happened in a week. No, Lehman Brothers and Bear Stearns were bankrupt a long time before it became public. The investor today, the institutional investor today, does not understand that fact. Why the financial assets that they're invested in, they're too overvalued. And so, but they continue, just like investors and CNBC continue to get people, Kramer, to go into Bear Stearns and Lehman Brothers, right up until the point they went under. And so I think the issue we're in the same boat. And so institutional investors, regular investors, are going to continue to buy U.S. Treasuries because they get a yield. They don't realize the danger they're in. So I think gold has been getting a lot of the geopolitical bid, but silver to me is actually, Jesse, the better investment potential in the future because there's not that much silver out there to acquire. When we start heading over the energy cliff and these financial assets get into serious trouble. So again, I start seeing this play out more as in about 2025, 2026. That's when we're going to see inflation and financial assets get into trouble.
You posed a question on Twitter recently where you asked how much longer can the US government print treasuries and the market continue to buy them? US outstanding treasuries have increased 66x the value of US gold reserves by the current market price since 2007. Talk about a bubble. So, how do you think this all ends?
Yeah, I'm glad you brought that up because I'll talk about the U.S. Treasury market first. Since 2007, and I've got several charts, and I went to the Silver Symposium in October, and I did this presentation there, and showing the issue since 2007, I put everything at zero. The U.S. Treasury outstanding by the end of this year will have grown $21.4 trillion in treasuries. We've added 21.4 trillion in treasuries. The the gold that the U.S. Treasury holds has increased in value if you multiply it by the market price of gold. 320, it's $320 billion. So when you divide the Treasury issuance by the gold, it's 66 times. What people don't realize, you need energy to generate economic activity to pay back those treasuries. And our GDP hasn't grown that much. Now let's move to the global. Since 2007, global GDP, which is inflated, has grown 28 trillion. The oil supply has only grown 13 million barrels a day. Jesse, the GDP is supposed to grow in relationship to a 1-to-1 ratio to about the GDP and oil supply. It's almost double. Let's just take that for what it is, 28 trillion in global GDP, real GDP growth. The financial assets have grown 281 trillion. They have grown 10 times the GDP. This is what I tell people. We have just enough oil, natural gas, coal, nuclear, hydro, wind, and solar to to supply the goods and services, the electricity to run this interview, the clothes, the gasoline you buy, the electricity. We have just enough energy to do the GDP. We do not have the energy to settle 10 times the amount of growth in financial assets. So this is a very important part that the institutional investor, the regular investor, they don't understand this dynamic because they continue to think we're going to have growing energy production forever. And so this is the key dynamic I'm trying to get people to understand. When we cannot grow our energy and it starts to decline, all that financial leverage is going to get into serious trouble. And that's when I start seeing, I call the transition from building wealth to protecting it. And so this is the aspect that the market is totally overlooking, just like they did with Bear Stearns, just like they did with Lehman Brothers. I see a global Bear Stearns Lehman Brothers event happening, and it's coming.
So let's just quickly cover your energy cliff thesis for those who might not be familiar. We discussed it pretty in depth in our last interview, so I definitely recommend people go back and watch that one. But for those who might not be familiar, what is the energy cliff? How will it impact the world? And maybe any new developments in your thesis that might have come about more recently.
Well, we know the cliff when you see Wile E. Coyote, right? He goes over the cliff, Roadrunner, and then all of a sudden he's trying to figure out where the ground is and he falls. We've been increasing oil production steadily. It's been a little rocky, but we added a lot of oil, about 13 million barrels a day since 2008, 7 financial crisis. 80% of that was from 85% was from US shale. That declines 45% a year. This is what people need to realize. People tell me, Steve, Brazil, they've got more oil they're going to bring online. Iraq's got more oil. There's Argentina, their shale. There's more oil that's going to come online. The issue is you have to remember, if we're producing 25 million barrels of oil a day in the world, that's it. And let's just say a 10% decline rate, you're losing 2.5 million barrels a year. Let's say you double that, you're doing 50 million barrels a day. You're losing 5 million barrels a year. We're up to 100. Now we're losing, my analysis is, we're losing at least 10 to 11 million barrels a day in declines. So let's say you get that thing up, you work real hard, you get it up to 105. Now you're losing a 10 and a half, 11 million barrels a day of production. So the higher you grow, the more you got to replace. And so what happens is the declines, what we've added in the last several decades are offshore declines faster, especially shale, which declines 45% a year. When you look at that, it's the Red Queen syndrome. And so that's why we hit this energy cliff. Even though we can bring on more production, it's just going to continue to offset declines. And then I think after 2025, it becomes impossible. And so then we start getting declines. And when you get declines, you cannot grow your GDP. And if you got all this finance out there, all these treasuries, this is an issue that the market is underestimating. And that's why we're going to hit the energy cliff. It's all about the numbers, Jesse.
That's very fascinating. I'm wondering how people watching this show, the goal of this show is to make people watching a better investor in the commodities sector. And obviously, we don't provide financial advice here. Do your own due diligence as always. But how do you think that those who listen to our conversation today can use this information to potentially apply to their own investment decisions? Is the message go long energy? Is it more subtle than that? What are your thoughts there?
In a nutshell, and you're right, this is not investment advice. This is kind of common sense and logic. The world, I call it, is a giant moth, acting like a giant moth, flying up towards the great flame in the sky, which is the financial industry, finance. And you know what happens when moths go to flame? They get burned out. So, but they still are attracted to the light, and that's what's happening now. And most of the increase in assets and gains for investors has been in finance and tech. I think as we hit the problems with energy scarcity, investors are going to have to be forced to move into real assets, because people don't realize this. Technology is going to get into trouble, even though we're still going to have technology. The ability to expand technology will be problematic, especially when you have limited resources. And also, finance is going to get into trouble, and I think real estate too. And we're seeing real estate in many areas, many countries in the world getting into trouble already. So I think the keep it simple, stupid answer is investors are going to have to start considering transitioning to real assets, sound assets like precious metals and gold. And there's a reason for that. They will become the highest quality collateral, even better than US Treasuries. And then mining companies, oil companies, because you know why? A treasury is a promise to pay. An oil company is going to provide you oil. Now, let's say their production is going to decline, they're still producing oil. Or let's say a mining company producing gold, they may have lower gold production. If there's less energy, they're still going to produce gold. And that's what they're going to supply the people who want to buy gold in the future. If you own a treasury, the let me tell you, the debt in the United States in the last year and a half it was 3.5 trillion. 3.5 trillion in the last year and a half. So Janet Yellen is pushing 3.5 trillion of new debt, new treasuries in the market. At the same time, Secretary Fed or the Fed Powell has raised interest rates 5.3%. So he's trying to cut inflation, and she is putting all this stimulus as in debt, and they're fighting each other. And so when you can add treasuries that way, and there's no cost, you got to remember, it's about a 85-90% cost to produce gold to the gold mining industry. It's zero cost to the treasury to add new treasuries. It's a cost to the public. So I think that's the whole difference. I hope I didn't go too long, but that's what people don't really get, why treasuries aren't really that valuable. They really won't hold their value in the future, especially the longer dated bonds.
Yeah, very insightful comments there, and this whole conversation has been very enlightening. Thanks so much for joining us, Steve. Before I do let you go, for those who want to learn more, could you tell us about the SRS Rocco Report, what it is you do there, and where people can find it?
Well, Jesse, thanks. Yeah, I run the SRSRockReport.com website. We've got memberships where I continue to update all the data on energy, the break-even cost, the mining industry, the metals. I spend a lot of time looking at the supply and demand forces with the metals and how it's impacting all these different the economy and all these different sectors. I update that on a weekly basis, and I'm also very busy on Twitter, as you know. And so I think if you want to understand what's really happening with the changes with energy, because the number one thing, you have to focus on energy first, because it's going to change all these different segments in the market. So I do appreciate you allowing me the time to share this information with your followers.
Absolutely. And I'll put links to the SRS Rocco Report website as well as your Twitter below. Thank you once again, Steve. It's been a great conversation and look forward to doing it again next year.
And have a good holiday.
Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.